Warren Buffett once said, "Only when the tide goes out do you discover who's been swimming naked." Now, he meant that it's during difficult times that weaknesses and vulnerabilities come to the fore. Now, the last couple of months have been such a time when the tide has gone out and the inherent weaknesses of many investor portfolios are out in the open. Now, if your portfolio is also bled beyond your expectations in the recent downturn, it may be time to assess how well you are managing risk in your portfolio. Now, that's important for two reasons. First, that'll help you prepare for a prolonged slump in the market if it happens. And second, it will help you build a more robust portfolio that can weather any market storm in the future as well. Hello and welcome to ET Money's YouTube channel. Today, we will talk about how you can manage risk in your portfolio. Now, this video is based on the takeaways from the Oaktree Capital video titled How to Think About Risk with Howard Marks. Howard Marks is the co-founder and co-chairman of Oaktree Capital Management. He's a renowned investor and writer, and his memos are much sought after. Warren Buffett says when he sees memos from Howard Marks in his email, they are the first things he opens and reads. You can watch the original video. I've included the link in the description. Now, in this video, we will discuss how to apply some of the risk management and risk control principle Marks discussed in the Oaktree Capital video. This video belongs to our playlist on investing lessons. If you'd like to watch more such videos, feel free to explore the link in the description. Okay, let's begin with the first lesson. Returns are why we invest, and unsurprisingly, they drive our investment decisions too. That means investors are often attracted to a fund that has done well in the recent past. Now, Marx suggests that one should go beyond returns and check how those returns have been delivered. Only then can one estimate their sustainability. For instance, a fund can deliver great returns during a bull run by riding on momentum stocks. But as the market euphoria fizzles, so will the performance of such a fund. So what makes a good investment then? According to Marx, an investment that gives market type returns when the markets are going up and contains the downside well when the markets are falling makes the most sense. And we couldn't agree more. A few months ago, we did research in which we found that funds that do well over the long time have superior downside protection capabilities rather than upside participation potential. I've included the video in the description. You can watch it for more details. Now, more recently, we did a video on funds that fall less during market downturns and do a good job overall. You can watch this video. The link is in the description. Now, as an action point, review the funds and stocks in your portfolio and assess why you bought them in the first place. Did you buy them because they were the latest buzz at time and everyone was enthusiastic about them? If yes, it may be time to re-examine them for more long-term performance and fundamental strength. Specifically, check how they behave when the markets fall. Alternatively, you can check the risk-adjusted returns as well. In the case of mutual funds, the Sharpe ratio and the Sortino ratio are two metrics to assess risk-adjusted performance. The higher the ratios, the better. In the case of stocks, a useful measure is beta. It tells us how a stock moves relative to the market. A high beta indicates a tendency to show high fluctuations. Now, this brings us to the next lesson. Investors often equate market volatility with risk. According to Marx, volatility is not risk. It's just an indicator of the presence of risk. So what is risk then? Risk is the probability of loss. Rising markets attract investors, but as they start to correct, investors perceive the increased volatility as risk and exit the markets in haste. And when they do this, they turn their notional loss into an actual loss. What else should you do then? First, understand that equity is going to be volatile in the short to medium term. So expect volatility when you invest in equities. Volatility is not an anomaly, but a central characteristic of the markets. Second, keep a long enough horizon that you don't have to suffer a loss. As the horizon increases, the probability of a loss reduces. For instance, consider the probability of loss across various timeframes in small caps, an especially notorious market segment, as represented by the Nifty Small Cap 250 Index. For any 1 year in the last 15 years, there was a 36% chance that the Nifty Small Cap 250 gave a negative return. However, if you increase the holding period to 3 years, there were 18% instances in which you made a loss. On increasing the holding period to 5 years, this probability reduced to just 3, and there was no chance of a negative return if you held the index for 7 years. That's why when it comes to equity investing, you should pay attention to the holding period rather than volatility. Alright, let's talk about the next takeaway now. Mark says that as an asset's price increases, it tends to become risky. Counterintuitively, more investors are attracted to it. On the contrary, if the price of an asset is falling, it may actually be getting less and less risky, yet investors tend to flee from it. Now look at the yearly returns of the Nifty 50 showcase is a similar phenomena. In many cases, whenever the Nifty 50 gave high returns in a particular year, the next year proved to be a tepid for it. For instance, in 2012, it gave a return of 28%. Next year, it generated only 7%. In 2014, it delivered 31%. In 2015, it fell by 4%. It registered a gain of 29% in 2017, but it delivered just 3% in 2018. A similar case can be seen in 2021 and 2022, and even in 2023 and 2024. The reverse is also true, as in 2008 and 2009, 2011 and 2012, 2013 and 2014, 2018 and 2019, and 2022 and 2023. The action point for an investor is to be cautious about an asset class that has shown a steep run-up. Now that doesn't mean you should exit it lock, stock and barrel, but rebalance your portfolio to restore the target asset allocation. Restoring the target asset allocation through rebalancing will not just help book profits on the overheated asset class, but also allocate to the undervalued asset class. This brings us to the next point. That's counterintuitive, right? After all, doesn't buying high quality assets provide better protection than buying low quality ones? Marx differs. He says that risk is not a function of an asset quality. A high quality asset can be priced so high that it becomes risky, and a low quality asset can be cheap enough to be safe. Marx says that investment success doesn't come from buying good things, but from buying things well. He reflects on his experience of the crash in the Nifty 50 stocks in the US in the 1970s. The Nifty 50 was a set of 50 or so high-quality large-cap stocks in the US. They were in such great demand that their valuation turned sky-high. As a result, between 1969 and 1974, they lost over 90% of their value, and half of them ran into serious fundamental problems. In India, over the last 3 years, many perceived high-quality stocks with high valuations have disappointed too. Of course, the fall in the stocks is much less dramatic than what Marx witnessed. And we're not saying that all high-quality, high-valuation stocks meet their fate or that can't do well. The point is that when you buy a good asset at a high price, you have less margin of safety. Any negative development in the company or the sector can result in a steep fall in the stock price. So, it's advisable not to overpay and be mindful of valuations. A good asset at a reasonable valuation is what you want. Now, recently we published a video on market valuations. We assess valuations from 4 perspectives in this video. If you are curious to know about the current valuations picture, this video is a must watch. As usual, the link is in the description. Let's see the next lesson now. But before I start with that, if you're finding this video useful and would like to watch more such videos, do subscribe to the channel. And don't forget to press the bell icon so you never miss a video from us. One of the adages of the investing world is that risk and return are directly proportional. This implies the more risk there is, the more returns there are. Marx finds this a terrible formulation. He says that if it were true then riskier assets produce higher returns, then they wouldn't be risky. So what's the right relationship between risk and return then? Marx says that investments that are perceived as being risky have to be perceived as offering higher returns. Now the operating word here is perceived. High risk doesn't automatically mean high returns. It just implies that high returns are expected, but whether they will be delivered is a different story. And you don't have to go far to witness this in the Indian market. While small caps are deemed to be riskier than mid caps, they haven't delivered better returns than mid caps over the last 15 years across various rolling return periods. So it's important not to unquestionably pick risky investments hoping they will yield higher returns. In fact, nothing stops the value of our high-risk assets to go all the way down to zero if the asset itself is fundamentally flawed. Let's take a look at the next aspect around risk now. While talking about the many types of risk, Marx calls selling at the bottom a cardinal sin in investing. That's even worse than buying at the top. That's because when you buy at the top and the market declines afterwards, you may have to wait a long time for your buying price to arrive. But if you sell at the bottom, you lose out on the entire recovery and may never be able to get back on track. Now, it doesn't take rocket science to understand this point. Take a look at the Nifty 50 chart over the last 20 years, not on a linear but a logarithmic scale. The logarithmic scale helps study major price changes irrespective of their start and end values. The chart makes two things quite clear. First, no matter how deep a crash or a correction, the market recovers smartly from the bottom. The 2008 crash is the deepest trough in the chart, followed by the 2020 COVID-related crisis, and then there are a few correction phases in the interim. Second, the recent correction is just a blip in this chart as compared to past corrections. Should it really worry us? Of course not. We have seen worse and got back from there to advance further. But imagine someone selling the bottom of the 2008 crash or the 2020 crash. Such an investor would be deeply regretting his decision. So the action point here is straightforward, or should I say the inaction point. Selling at the bottom never helps you mitigate risk. It's actually the riskiest thing to do. Please don't do that. This brings us to the next point. Marx says that the risk of an activity lies not only in the activity itself, but also in how the participants approach it. Risk is low when investors behave prudently and high when they don't. This is an interesting point as it also puts the onus on the investor rather than just the investment. One recent instance of undesirable investor behavior is the rising SIP stoppage ratios. SIP stoppage ratio is the ratio of number of SIPs discontinued or whose tenure got completed to the number of new SIPs registered. A ratio of over 100% suggests that more SIPs were discontinued than registered. This in turn suggests a dwindling investor confidence. Now, the stoppage ratio reached a high of 123% in February 2025, up from 109% in January 2025. Of course, SIPs whose tenure was completed also have a role to play in this, but the spike in the stoppage ratios coincides with a recent fall in the market. Notably, the ratio has been rising since September 2024 when the ongoing correction started. Discontinuing your SIPs when markets are falling is a mistake as it prevents the averaging of your investment costs lower. SIPs done at lower market levels go on to lift the overall returns as markets recover. So the problem is not with SIPs, mutual funds or the market, but with investor behavior in exiting the market during the fall. This is the risk that Marx talks about. The investors who have exited will not only have suboptimal returns, but may also find it difficult to return to the market. And adverse investor behavior doesn't stop here. It comes in all shapes and sizes. A few examples are on screen. Okay, let's move to the next point now. Okay, so if managing risk requires so much grit and intelligence, shouldn't you just avoid it altogether? Why not invest in bank deposits that promise fixed returns? Marx said that risk avoidance is not an appropriate goal in investing. Risk is something to be managed and controlled, not avoided. And that's because risk avoidance ultimately equates to return avoidance. Basic investment maths is sufficient to prove this point. Rupees 10 lakh invested at 7% fixed returns would yield 54.27 lakh in 25 years. The same amount at 12% market returns would be over 1.7 crore. The problem is the 12% market return isn't linear. One year you may make 15-20% and another year you may even have to lose money. Now, this unpredictability of returns is often perceived as risk and compels investors to go to fixed return avenues. But by doing so, they don't really escape risk. If you accumulate less amount over a period of time than it is required, it is a risk in itself. For instance, an insufficient corpus in retirement is much riskier than the risk originating from market volatility. The key lies in the ability to handle and manage risk, not to avoid it. This brings us to the last point. Risk control is not a one-time exercise. Mark says that risk should be dealt with constantly, continuously, not sporadically. He further adds that highly skilled investors assemble portfolios that will produce good returns if things go as expected and resist declines if they don't. Also, Marx asserts that risk is best assessed through subjective judgment. He says that imprecise, qualitative expert opinion about the probability of loss is far more useful than precise but largely irrelevant numbers concerning volatility. Now, what does this imply for investors? If you are assembling a portfolio of securities yourself, risk control has to be an inherent part of it, not something you leave out for a later date or something you pay attention to only on and off. Second, while generating good returns is the obvious goal of an investment process, don't ignore downside protection. Third, if you find yourself unable to manage risk in the portfolio, you can go for expert managed investments where risk is controlled methodically and professionally. The eMoney app provides you a number of ways to control risk in your portfolio. Do explore it today. And with this, we have come to the end of this video. I hope you found it useful. And if you did, do share it with your friends and family. I'll be back soon with another video. Till then, take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.